have some other companies to talk about as well. Swiggy IPO will hit D Street on November 6th. Our colleagues Shilpa, Ranipeta and Mangalam Maloo spoke to Sriharsha Majety, the Managing Director and Group CEO of Swiggy, along with Rahul Bothra, who is the Chief Financial Officer at the company, and began by asking them about the sustainable growth on top line and path to profitability for food and quick commerce sector.
In the food delivery business, we turned profitable, not only at the contribution margin level, but at the EBITDA level. In terms of the overall platform growth has been very strong for us over the last 3 years, growing at 32% and scaling well. So overall, we are very happy with the trajectory that each of the businesses are demonstrating.
Right, but you're not saying what the street wants to know, because while they have turned contribution positive for the food delivery business, and they say on the street, and EBITDA. On the street, they say, ye dil mange more, right? Now that you're listing, you also have a listed peer. With the trajectory that we've seen on them, on a lot of the parameters, they're above, what Swiggy is right now, which is not to say that you're any less. It's just that you're at different stages of growth in your life.
Correct. I think, look, there's a lot of context. We each have our own context. And we are in very, very exciting categories. And our strategy, our capital allocation, everything's going to be a function of our excitement and what we can go after in each of these. Like Rahul mentioned, we've demonstrated the profitability in the food business. We feel good about its future going forward. As for quick commerce, I think it's in a once in a lifetime category. And I think we are seeing consumption patterns change for consumers, and there's so much to be done. So our endeavor will be to make sure that we do the fullest of our ability to make sure that we grow and serve customers well and make sure that everything comes together nice.
But for quick commerce, you recently said that the peak of the investment is behind you, but you're still not a contribution margin positive either. So, I mean, what is the trajectory there for quick commerce? Because even for your peer, that has been the growth driver. Right. So how are you looking at the quick commerce business for you in terms of being, is it also going to be the growth driver for you? And sort of trying to get a sense of the path of profitability on that front also.
See, maybe I'll take this. I think on quick commerce, what really amazes us is the way consumers are reimagining, things or what can be delivered to them. So it's almost like every quarter we have to recalibrate around, what is the number of categories that we have to be there, what is the number of SKUs we have to launch, and there's a recalibration happening. Growth is accelerating. So there'll be a certain amount of, say, new store additions that we'll continue to do. The old stores continue to mature well, which means that they become profitable over a period of time, and the new stores come in because consumers want a lot more. Right. So I think it's a recalibration of our overall growth trajectory in line with the demonstrated path to the contribution margin that we continue to will demonstrate.
So let's get a little more specific now. As of the first quarter, you had around 557 e-commerce, quick commerce dark stores. How many of them are mature? How many of them, and mature stores, what is the contribution margins that they do? If you could give us that sense. And you are doing about 980 or closer to 1,000 crores in terms of dark store expansion. So what's the aspiration there? How many are you looking to add? And over the next couple of years, what's the milestone target that you have?
No, we will give specific numbers and not just directional numbers when we can. Currently, there are regulatory constraints that we cannot talk about. But to give you a sense of where are how are we planning our overall store expansion, I think store expansion is a derivative of growth and not otherwise. It's not like we want to add number of stores, which is ahead of even the growth journey. So, calibration will happen according to the growth of the category.
What proportion of your stores are contribution positive? If that could...
We will give it in our first earnings call.
But, I mean, at least in terms of maturity where we are, we're looking for some color on that front.
I think you're trying your best.
Okay, let's try it this way. How much does it cost to open one dark store?
So in terms of the overall capex requirement, it could vary depending on the size of the store, but anywhere between 65 lakhs to 85 lakhs is what we have seen.
So roughly 986 crores is what you're putting out for a dark store expansion. 65 to 85 would imply closer to 1,500 dark stores over the next 18 months or 20 months, depending on the rate at which you deploy it. Would that be a fair assessment? You're not saying anything. I'm just doing the back of the envelope.
I think the overall time to market of deciding to start a store store and then launching it is actually less than a quarter. So I think we are in an agile world. I think, as I said, the
So less than 1,500 stores adding in less than 4 quarters. That's the headline that we got.
consumers are reimagining, and we are definitely going to deliver what consumers are.
How do you see the competition for the quick commerce space, and do you think there is space for 5 to 7 or more players, down the line? How do you see this market settling, and how are you looking at the competitive landscape right now?
Okay, cool. See, I think at the outset, I'd like to maybe start by saying that there will be multiple players in any large market that you go after, and I think quick commerce is no exception. So there will be multiple players at the end of it. It's not going to be a winner-takes-all market. The next one is, as for, let's say, multiple players, etc., every category. Now, if you go back and trace back even the food delivery business, there have probably been like 25 competitors. Today, it doesn't look like it. Feels like a long-lost memory. But I think many folks will play, and the ones who are, building sound, sustainable businesses while serving consumers well will come out on the other side looking good.
Food delivery business right now, we've seen it's just we just have Swiggy and Zomato that is really able to. It's become a duopoly. How do you see the quick commerce that way?
Like I said, I think if you just go by market structure, it is a function of market size. And if, let's say, the quick commerce market is going to be larger than the food delivery market, it'll probably be able to serve more than 2 players. Whether there will be 2, 3, 4, I don't have crystal balls, so I think we just keep doing what we can.
On the food delivery business, you've turned positive over the last 3 years. We've seen that J-curve effect play out as well. Contribution margins closer to 6.5% right now. The peer at a larger scale is doing a little around 7.5%. What is the steady state contribution / EBITDA that one should look at when they look at the food margin?
No, I think we again can't give specific guidance here, right? But I think from the overall industry standpoint, there are industry reports that suggest that this could be a 5% EBITDA business.
Got it.
And I think the contribution margin trajectory will.
And your current EBITDA in the food business would be?
So we delivered a 0.8% in our Q1.
Got it. So there is chance for this to quintuple from here, from 1% to about 5% over the future as it
there is
stabilizes.
obviously the contribution margin expansion journey as well as the operating leverage. What happens in platform businesses is that once you hit a certain scale, the incremental fixed costs that get added is significantly lesser than the overall scale benefit that happens. And we will demonstrate both operating leverage as well as the contribution margin expansion.
A lot on the street thought that you would come at a value much higher than what actually has happened. How much of the discussion happened during that time, and what led to you all valuing your company at the numbers that you did as against what was earlier perceived?
See, I think we were, both Harsha and I spent a significant amount talking to investors over the last 4 weeks, as you can imagine, in any IPO roadshow. We heard the sentiment. It was a fair price discovery process, and I think investors have given it a certain price, which is what we have come out with. I think it's ultimately for the street, for the retail investors out there to decide.
A very interesting conversation there with Swiggy. Now moving on, let's now slip into a short break. Parvaz Srinivas Reddy from MTAR Technology joins us next to discuss their Q2 performance and the way forward. Stay tuned.